Hello and welcome. If you're navigating the complex world of non-resident taxation in India, there's one section you absolutely have to get your head around, Section 60 of the Income Tax Act 2025. Today, we're going to break down exactly how this provision works for head office expenses. Okay, so here's our game plan. We'll kick things off with the core business problem this section tries to solve. Then we'll dive right into the law itself, see how the calculation works with a real example, cover the all-important compliance, and wrap up with some common mistakes you'll want to avoid. All right, before we get buried in legal text, let's start with a practical, real-world situation. Framing it this way really helps to understand why this law even exists in the first place. So, here it is, the classic challenge for any multinational. Your head office is supporting operations all over the globe, including in India. The big question is, how much of that central cost can your Indian branch actually claim as a deduction here? This whole issue of fair allocation, well, that's exactly what Section 60 is designed to address. Okay, with that problem in mind, let's look at the legal tool itself. What does Section 60 of the Income Tax Act 2025 actually say about all this? First things first, the law gives us a pretty clear definition. When we say head office expenditure, we're talking about those central command costs. The big picture executive and general admin expenses that happen outside India but support the whole organization. Now, this is absolutely crucial to understand. Section 60 isn't just another guideline. It's what we call an overriding provision. That means it basically trumps the normal rules for business expenses and imposes its own very specific formula and its own hard limit on what you can deduct. Now, for all you seasoned professionals out there, this logic might feel a bit familiar. That's because Section 60 of the new Act really just carries forward the main ideas from the old Section 44C of the 1961 Act. The fundamental thinking behind limiting these deductions has stayed the same. So, at its core, the law boils down to a simple two-part test. First, you figure out a legal cap, which is 5% of something called your adjusted total income. Second, you calculate the actual head office expense that you can link to your Indian business. The amount you can actually deduct, it's simply the lower of those two numbers. It's a straight comparison. Okay, so you're probably wondering, what on earth is adjusted total income? It's a really key term. Just think of it as your total income calculated the usual way, but, and this is the important part, you calculate it before you take out the head office deduction we're talking about. This avoids a weird circular calculation where the deduction changes the very number it's based on. All right, enough theory. Let's put some numbers to this and see how it all comes together in a practical example. This is where the rules really come to life. Let's walk through this with our example company, Global Corp. So, their adjusted total income is 10 crore rupees. Step 1. The legal ceiling is 5% of that, which comes out to 50 lakh. Now, look at step 2. Their actual attributable expenditure was 75 lakh. Since the rule is you have to take the lower of the two, their deduction gets capped at 50 lakh, even though they actually spent more. And there you have it. The final number is 50 lakh rupees. This example just perfectly shows how that statutory ceiling acts as a hard limit, no matter what your actual expenses might be. So, the math is pretty straightforward, but getting the number right is only half the battle, isn't it? The next, and just as critical step, is being able to prove it all to the tax authorities. And that brings us to compliance and documentation. The foundation for all of this starts with your books. Section 59(4) of the Act is very clear on this. If you're a non-resident with what's called a permanent establishment in India, you have to maintain separate audited books of account for that Indian operation. This is absolutely non-negotiable. And that audit report? Well, that's just your ticket to the game. To actually back up your claim, you need a really solid paper trail. We're talking about those audited accounts, a detailed breakdown of your global expenses, and, this is so important, a clear, logical explanation of your method for allocating those costs to India. And of course, you need the invoices to prove it all. Okay, so we know the rules, and we know what paperwork we need. Now let's talk about where things often go wrong. Understanding the common traps is the best way to avoid falling into them yourself. These right here are the classic tripwires. You make a small math error calculating the adjusted total income, and your whole claim is off. You use a weak or random allocation method, you can bet that's going to get challenged. And of course, trying to claim payments that aren't for real expenses, or just not having your paperwork in order, well, those are pretty much guaranteed ways to get your claim disallowed. Whew, we've covered a lot of ground. So let's just pull everything back and distill it all down to the most important must-remember points from today. If you remember nothing else, remember these 4 things. 1. Section 60 is a cap, not an automatic right. 2. That lower of formula is the law of the land, it's non-negotiable. 3. Your documentation has to be rock solid. Your claim is only as good as the proof behind it. And 4. The audit isn't optional, it's mandatory. These are the pillars for getting this right. And I'll leave you with a final question to chew on. This definition was written for a pretty traditional, old-school corporate structure. But what happens as businesses get more decentralized, with remote teams and leaders spread all over the world? What exactly is a head office expense then? It's a fascinating question that the tax world is going to be wrestling with for years to come.
And that's a wrap on our deep dive into Section 60. Thanks so much for joining us. If you found this explainer helpful, please do us a favor and like, share, and subscribe for more content on tax law.
And just a quick reminder, as always, this content is for educational purposes. Tax law is always changing and can be very complex, so please make sure you consult with a qualified professional for advice that's specific to your situation.